Jason, good morning.
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 Lisa, good morning. Connor, good morning.
Good morning.
Is it really? Isn't it? It's almost afternoon, isn't it? Hey, Kristen, good morning. Bryce, good morning when you can hear me. Have you got your slides for chapter 9? Because that's what we start with today. Brandon, Kayla, Mercy, good morning. Macy, good morning.
Morning.
I've been seeing a commercial on TV where two actors, a young guy and a real young little girl, say, "Mercy," sticking in my head. James, good morning.
Good morning.
Oliver, good morning. You guys, it's okay. Your faces are like a dark shadow. That's okay. It doesn't matter whether or not I see you. What matters is whether or not you can see me, so you'll be able to see the PowerPoint slides and the stuff I write on the whiteboard. One of the guys I work with sent me an article in the New York Times I need to read as soon as this class is over. It's called Zoom Bombing. You know, like, I have no idea what that is, but I hope that's not putting Zoom in jeopardy. Paulina, good morning.
Good morning. How are you?
Hanging in there. Kayla, good morning. Sam, good morning. Daniel, good morning. Although it's about to be afternoon, isn't it? Zana, good morning. You know, most of you have your name on your little window, but some of you have something cool, you know, that's different. And it's so funny, I asked my 10 o'clock class at one point if they were getting something, and suddenly a lot of yellow thumb icons popped up. I need to figure out how they do that. Bryce and Daniel, thank you, sir. Sirs. Well, I've nearly got time to start. 2 or 3 things. I did post your course averages. I didn't bother to post the individual. Jason, is that a stop signal? I didn't post your individual attendance points and ethics thing. I just built it into your exam scores, just as I did when I handed them out in class for you to look at. So you should see your average, your project points, and 2 exam scores. And I had posted, I'd sent you an email that the final exam would be 30% multiple choice questions and 70% multiple choice problems. The whole thing may well be multiple choice. With my graduate classes that are smaller, I don't even give them multiple choice problems. I give them open form. They write it on a scratch sheet of paper, use their phone, take a picture, and send one picture in for each individual problem. And the numbers in terms of students and problems, their problems are a lot longer than yours, are low enough I can handle that. But I've got two reasonably large 341 classes, and your problems are a lot shorter, so there are more of them. And that just won't work. I think I'm going to have to stick with the multiple choice for the whole test format. I don't know if I'll stay with that 30-70 or if it might be 25-75, for questions versus problems. Give me a day or two to mull over that. In fact, I haven't created your final exams yet. I'd like to do that. See how that works out. And then I'll let you know. I'll let you know shortly. And I probably overwhelmed you with information on ProctorU. Short version is, at least 3 days before your exam, it would be good to go ahead and register for your ProctorU final exam. How many have used ProctorU have taken an online exam in any other class? Anybody? Kristen, Kayla, Paul, the other Kristen? Okay. No, there's one Kristen. I just looked at it. It shifted around as more people joined, the squares move on me. All right. I guess that's enough of the order of the day. We can go ahead and get started. We're starting with chapter 9, which is stock valuation. Do you all have the slides I sent you? You're going to need them. I know you all have them. I sent them. I just don't know if you have them in hard copy or pulled up or whatever your approach is going to be. First, let me say this. There are two types of securities that corporations sell, two major types, stocks and bonds. We had an earlier chapter on bonds that was on your second test. Now we're looking at the valuation of stocks. I thought I'd show you something that may or may not amuse you. Microsoft was formed, I think, back in 1978, and this was the whole team. That funny looking little guy in the bottom left, that was Bill Gates. And I love the caption. It says, would you have invested? If you look at this motley crew, would you put your money up? This absolutely serves no purpose other than to amuse me. I just thought you might like to see this. You never know what's going to turn into a monster company. Okay. First of all, there are 3 valuation models covered in this chapter. The first of these is called the dividend model. We won't even finish it today. We'll get most of the way through it. Another model is called the corporate valuation model. Why 2 different models? Well, for one thing, not everybody pays dividends. In fact, most companies don't. That's where the corporate valuation model comes in. Most of your problems out of this chapter, almost all of them, will either be the dividend model or the corporate valuation model. They're sound. Their assumptions are sound, they're valid. A less solid model is called the use of price multiples. And the reason that price multiples are not that good to use, they really don't work that well. Anyway, So let's proceed to the first of these, the dividend model. At one time, every company paid dividends. That's why the financial literature first came out with this dividend model. The guy by the name of Myron Gordon, for that matter, came up with the model, but it works like your bond valuation model. Back in your bond chapter, if we wanted to find the value of a bond, we assumed it was the present value of all future cash benefits. Of course, with bonds, the future cash benefits eventually ended because bonds mature. We use the same approach with stock. The dividend model basically says, if you buy a share of stock and hold it forever, your only future cash benefits will be the dividends. And that's the basis of the model. Now, companies actually pay dividends, pay them quarterly. Our author and my slides assume that dividends are paid annually. While that looks like an effort to make the problem simpler, and it does, believe it or not, it actually it corrects for a bias that's way above the level for this course. So believe it or not, assuming dividends are paid annually in our problems, yes, it makes it simpler, but it also serves a useful purpose. But like I said, way beyond our course. Now, if you wanted to find the present value of a share of stock, you discount all the future dividends back to the present. You discount the first dividend back to the present, 1 year. The second dividend back to the present. Since it's 2 years away, you discount it back 2 years, and so on. And by the way, just as we used R sub D back in the bond chapter to represent a bondholder's required return, we use R sub S, S for stock, to represent the stockholder's required return. Now, I'm going to bore you to tears for a little bit and then show you something that bails everybody out. But what's the problem with this approach? When would we finish? When the company's stocks mature? They don't. Theoretically, they go forever. And our approach, we start with just recalling, first of all, this basic formula. Whoops. That says if we want the value, for instance, the present value of any future dividend, we divide by 1 plus our discount rate raised to the second. So for example, let's say I've got a company and we're looking at a dividend in year 2 of, I don't know, $5. Whoops. Dirty little lines. $5 per share. And stockholders for this stock want a, let's make it simple, 10% required return. Then what would be the present value of that second dividend? Using our model that we used back we started with in the time value chapter. The present value would be the dividend in year 2 divided by 1 plus our discount rate raised to the second power. All I'm doing right now is looking at how we would find the present value of just that second dividend. If that second dividend were $5 and our discount rate was 10%, but if you recall, when we're using algebraic time value formulas, all the interest rates and required returns need to be in decimal form. So what would 10% be in decimal form? 0.10. Then we'd raise that to the second power. Forgive me, I'm making this stuff up. I'd get to rounded to the nearest penny, $1.65. No, wrong. Sorry. Calculator operator error. $4.13. So that's what we're talking about in finding the present value of all the future dividends. We find the value of each dividend and then we add them up. Now, graphically, what we're doing is this. We're taking all the future dividends all the way out to infinity, discounting them back to the present. And that's how we come up with the price. That's the dividend model. It says the value of a share of stock is the present value of all the future dividends, discounted back to the stockholder's required rate of return. Now, if we assume that the dividends grow at a constant rate, that is, each one is a certain percent higher than the other, let's say some constant rate G, then the dividend in year one would be the dividend in year 0 times 1 plus G. And your author defines the D0 as last year's dividend. If you want to think of buying the stock on January 1 and D0 was the dividend paid the prior day, you wouldn't get D0. Then D2 could be found by taking D1 and again multiplying it by 1 plus G. That actually works out to D0 times 1 plus G squared. Just to clarify, if I wanted the dividend in year 3, I could take the dividend in year 0, multiply it by 1 plus G, and raise it to the third power. So for instance, if the dividend in year 0 was $2 and the growth rate was, let's say 5%, then the dividend in year 3 would be that $2 times 1 plus. And by the way, what's 5% in decimal form? Anybody?
0.05.
0.05. You'd be amazed. I don't mean to insult your intelligence, but you'd be amazed at how many students on an exam will call that 0.5. It's not, it's 0.05. And we end up with $2.32 if I round it. Okay. and that's per share. Now, if we assume dividends do grow at a constant rate, the model becomes even scarier. Looks nastier, doesn't it? This thing down at the bottom. But if you called in a mathematician to look at that model, the mathematician would tell you that's what's called a power series, but a well-behaved power series, because this monstrous little model reduces to that simple ratio. D1 divided by R sub S minus G. And of course, these need to be, because this is an algebraic present value function, these would need to be in decimal form. Yeah. One of the downfalls of PowerPoint is if you try to write on the slides, they go nuts. I have to write very slowly. Now, what is that? That model is the present value of a series of payments that go forever. And each payment is G% bigger than the last one. They grow. And where R sub S is our discount rate. If you ever get hurt on the job and it permanently disables you from working, and you go to court to sue for the lost future wages, this is what will be used. I had to serve as sort of an expert witness on this type of thing once before. Now we tweak it to take into account the fact that you wouldn't live forever. But that is the basic model. It has a lot of uses. Now, what does it mean if something grows at a constant rate? If you're making $50,000 this year and you expect a 5% raise every year forever, will each raise be the same dollar amount? What should happen to the size of your dollar raise each year? Should get a little bit bigger, right, right. So what you find, just like with your salary, if you got a constant raise, percent raise, like 5% every year, it wouldn't grow up, it wouldn't go up as a straight line, it'd go up curved. That's what we assume when we say a constant growth rate in the dividends. We're assuming each dividend is a bigger dollar amount higher than the prior dividend. That's what a constant growth rate gives you. Now, let's get out of all this theoretical junk and see how we would use this. And for this, I go to my whiteboard because it's stable. I can write and the pen doesn't jump around. I don't have that problem we have with PowerPoint. All right, we've got the Cobb Corporation stock. And for Cobb Corporation, the stockholders require a 15% return. The riskier the stock, the higher that required return would be. I don't know if they use beta to get that, pardon me, the CAPM to get that. Well, look, the CAPM, just a trip down memory lane very quickly. if the stock gets riskier, if its beta goes up, the required return goes up. You know, it's just a basic risk return trade-off. We're risk averters by nature. So the higher the risk, the higher our required return. So, and by the way, don't freak out if I erase something before you can copy it, because this is all being recorded. Should be available to you in the form of a YouTube video by tomorrow afternoon. And I'll post the link on your Moodle website. All right, so back to the ranch. Cobb stock has a required return of 15%. The dividend paid last year for the year just ended was $2. And we expect those dividends to grow at a 5% rate forever. So what is the value of the Cobb stock? Here's that formula. And by the way, the funny little hat, that just means estimate. That's our estimate of the value of the stock. This gives us what's called the intrinsic value of the stock. In English, that's code for the true value, what we think it's worth. Now, if we work this out, notice we're given D0, not D1. So we have to make a little preliminary step to get D1. D0 was $2. Our growth rate, 5%. You guys know if I say 1.05, that's the same as 1 plus 0.05, right? So the dividend in the coming year, which is what our formula uses, is 210. So our estimate for the value of the Cobb stock would be 210 divided by R sub S in decimal form would be what? Would it be 15 in decimal form? It'd be 0.15, right? And likewise, the growth rate in decimal form would be 0.05. And we'd come up with a value for the stock of 21 per share. That's what we think the stock is worth. If we look in the market, if we trust our model and we look in the market and the stock is trading at like, $18 a share, we'd buy it. If it's trading at $25 a share, we'd say the price is more than it's worth. No thanks. So, just for grins, try this one. Well, I've got to go really slowly with this guy. All right, we've got, I don't know, Rimsky. Rimsky Corporation. Rimsky's riskier, so the stockholders, they want a 20% return. The dividend paid in the last year was $1. And they expect the growth rate to be 4% forever. What do you guys come up with for the value of the stock? Take a second and tell me what you get. Automatic A to the first correct answer. Just kidding. Sorry. Somebody take a chance and tell me what figure they're getting.
6.5.
That's right, James, 650 a share. Now, know what we'd have to do. We're not given D1, we're given D0. We're given the dividend for last year. And in this model, we need the dividend for the coming year. Whoops, sorry. D1. So we would first have to do a little housework and calculate D1. So that'd be what, $1 times 1 plus 4% is 1.04. So the dividend in the coming year we're expecting would be, $1.04. So our estimate for the value of the stock would be $1.04 divided by what? 20% in decimal would be 0.20. What's 4% in decimal?
0.04.
0.04. You'd be amazed at how many of you are going to say that's 0.4. Anyway, you come up with a value for the stock of $6.50 per share. That's what we think it's worth. If it's trading for less than that, like $5 a share, and we trust our model, we'd buy the stock. If it's trading for $9 a share, we'd say no thanks, it's overpriced, and not buy it. One more problem, just for grins. What if the information I gave you was like this? Sorry for the slow process here. And this. What if I've got, I don't know, let's call it a different name. What if I've got the Korsakov Corporation? Whoops. And they require a 12% return on their stock. And the dividend in the coming year is, I don't know, $5. And the projected growth rate in dividends is 7%. Now what do you get for the value of the stock? Anybody? James, you got it again already?
100.
$100. What's different about this problem and the last one? Did we have to go through that intermediate step to calculate D1? No. It was given to us. D1 was given, it's $5. Divided by 12% minus 7% in decimal form would give us a value of $100 a share. why did I do this? In some problems, you're going to be given the dividend for last year or the year just ended. That would be D0. In some problems, you're going to be given the dividend for the coming year. My point being that D0 is the dividend for the year just ended last year. If they give you D1, whew, golly, it's terrible. That's the dividend expected in the coming year, a year from now. And in different problems, you're given either the dividend for the year just ended, in which you need to make this little adjustment. And in some problems, you're given the dividend for the coming year. So you don't need to make the adjustment like this one. It's a small point, but you'd be amazed at how much that trips students up. All right. I asked you this in class, where's your confidence level? Let me see all of you. How many of you feel like you're getting it? 10s, thumbs up, the yellow thumb up. Thank you, Bryce and Jason. Okay. Now, sometimes we have a problem where we're given our required rate of return and asked to find the stock price. But sometimes we're given the stock price and asked to find what our required rate of return or expected rate of return would be. For example, what if that Cobb stock you could buy for $15? What would be your expected return? If you look down here at the bottom, 19%. Let me change that up ever so slightly just because I don't like using that 15 twice. Let's say we've got Cobb stock. The dividend in the year just ended was $2 a share. We expect those dividends to grow at a 5% rate forever. If we can buy the stock for, let me change this, instead of 15, let's say, oh, I don't know, $18 per share. What would be our expected rate of return? Well, here's our basic dividend model, right? What would, whoops, not plus, minus Cudd. Ooh. By the way, that's another mistake students make. They'll make that a plus instead of a minus. If we rearrange that formula to solve for our wrong formula, I'm sorry, guys. This is what I should have had, right? That's the basic dividend model. If we rearrange the formula to solve for R sub S, we end up with D1 over P0 plus G. So if we could buy the stock for $18, what would be our expected rate of return? Sorry, one little thing. Let's do one. There we go. Again, since we're given D0, we'd have to do a little house cleaning to find D1. So $2 times 1 plus 5% would be 210. So our expected rate of return, 210 over, we're paying 18, that would be $18, plus the growth rate, which, whoops, in decimal form would be, what, 5.05. Notice this is still that algebraic time value formula up here. So any growth rate or return has to be in decimal form. This would turn out to be, since I changed it up, 11.7%. And this in percent form would be 5%. That would give us a total return of 16.7%. If you recall, our original required return was 15 with Cobb. Now, what if you can buy it for a lower, and we came up with a price of $21. If you can buy it for less, your return ought to be higher, and it is. It goes up from 15 to higher. Back in your bond chapter, you were taught there is an inverse relationship between bond return, bond yield, and bond price. It also exists for stocks. The higher, well, put it this way, the lower the stock price, the higher will be your return. So if I ask you on a test, is the stockholder's return and stock price positively related or inversely related? It's inversely. If the yield goes up, if the required return, R sub S, goes up, stock value would go down. And likewise, if the, or in terms of this model, if the stock price went down, your return would go up. And that's what we just observed. They go in opposite directions. Try one more. Let's say we've got, I don't know. I wonder if what I'm witnessing is part of what they call Zoom bombing. Anyway, let's say we got the Korsakov Corporation. And the stockholders' required return was 20%. Yep. Sorry about that, guys. This is something new. The required return is 20%. What was the dividend for the year just ended? Oh, Golly, it's doing it. Hang on a second. I'm going to put on the glove. Be right back. My screen is reacting to this touch my skin. It's not supposed to. All I could find was a big clunky garden glove, but maybe this will work. I can hold a pen. Okay. Stockholders were requiring a 20% return. The dividend for the year just ended was what, $1? And the growth rate was 4%. And using this information, we found a value for the stock that is working better. Let's see, D1 was $1.04, remember? And we found the value for the stock of $6.50. So now I'm changing it up. If you can buy the stock for, well, I don't know. Let's say you can buy the stock for $5 a share. What is your expected rate of return? That is, what is your new R sub S? Using our formula that we had earlier, our return would be D1 over P0 plus G. And I think we found the dividend in the coming year was $1.04. And now if we can buy this stock for $5 a share, whoops. Growth rate is still 4%. We should get, oh great, can't punch my keys. Sorry. Try that again. I'm getting 20.8%. In percent, that would be 20.8%. And of course, 0.04 in percent would be 4%, and our return would be 24.8%. Is anybody getting that figure? Okay. So again, if the price goes down, our return goes up. If the price goes down from 650 to 5, our return goes up from 20 to nearly 25. They are inversely related. Now, one of the unique things about the dividend model is it happens to lay itself out in the following form. Back at the very start of chapter 8, the dividend over the price was what we called dividend yield, right? And in the world of the dividend model, the only way that dividends can grow at a constant rate forever is if the stock price also grows at that same rate. So in the dividend model, G is not only the growth rate in dividends. What's another name for the growth rate in your stock price? That's your capital gains yield. So if we're working with, for example, I guess I'll go back to Cobb. We've got a stock price. We came up with a value of $21. Growth rate in dividends of, what was it, 5%? And a dividend for the year just ended of 2. So if we were to use the Cobb information and parcel it into the two components of return. For instance, what if I ask you on a test, how much of your total return is dividend yield? How much is capital gains yield? Well, again, since we were given these 0, D1 would be 210. The price of the stock, $21. That would give us a dividend yield of 10%. And since dividends are expected to grow at a 5% rate forever, that's also our capital gains yield. And that gives us our total yield of 15%. The key point is the dividend model is laid out so it shows you the 2 good things that can happen if you buy a stock. You can pay a dividend, in which case you get a dividend yield. And if the stock price goes up, you have a capital gains yield. So, just for grins, try this one. Let's say, I'm just making this stuff up, guys. Let's say Zulu Corporation. The stock is trading at $20 a share. No, 25. Quit doing that. Again with a glove. Okay, the dividend in the coming year is, I don't know, what, $4. And dividends are expected to grow at a 6% rate forever. Here's my test question. What is your dividend yield? What's your capital gains yield? What's your total yield? And of course, that would be R sub S. Try that and tell me what you come up with. Let's see. How many of you got a dividend yield of, what would that be? Why can't I do that? 16%, is that right? Yeah. And for the capital gains yield, so your total yield is 22%. Did anybody get that, or am I off? Good. I love to see the thumbs up because I make math mistakes all the time. All right. I'm purposely skipping some of the green problems in the slides so you'll have more problems to work on your own. Let's skip Zumba and let's look at this. In the long run, by the way, you can skip that earnings per share part, just ignore that. In the long run, the only way dividends can grow at a constant rate is if the stock price also grows at that rate. Now, what that means is, for example, but let's say we've got a stock the dividend for last year, or the year just ended, was $2. The stock price was 21 bucks. And the expected growth rate, and I apologize, I didn't give this to you on your slide. Add this to slide 15. The expected growth rate is 5%. So what would be the dividend per share and the stock price in year 6? Well, the model says the dividend in any year T would be the dividend for the year just ended times 1 plus that growth rate raised to the t. Same for the stock price. The stock price in any year t would be the price in year 0. The price today times 1 plus that growth rate raised to the t. So if I want the dividend in year 6, I take the dividend for the year just ended times 1 plus that growth rate raised to the 6th. And that would give me a dividend of 268. And since the stock price has to grow at the same rate, we would expect the stock price 6 years from now to be a little over 28. These are two good formulas for you to salt away. Maybe make it to your memory aid sheets. By the way, I didn't say, I don't even know if anyone asked this. For the final exam, since it's a 200-point exam, you'll be allowed 2 memory aid sheets with anything you want on them, front and back, typed or handwritten. And of course, you're also allowed in all the blank sheets, scratch sheets you want. Okay. Do you follow this? Let's see. What if I ask for the value, let's say, instead of year 6, what if I go for year, well, I don't know, year 10? What would you find for the dividend in year 10? What would you find for the stock price in year 10?
For those 2 cheat sheets for the, or memory aid sheets, will you tell the proctor you people?
Yeah, I put that on their guide sheet. I tell them what you're allowed.
Okay.
And they will check it. Look, let me tell you, I don't know how many of you have used ProctorU. They are a pain. They vet you for, it may take 30 minutes for you to get through and get vetted. And when I say vetted, they make you show them multiple picture IDs. They make you take your camera and pan the room to show there are not other students or helpers in the room. But your 3-hour clock does not start until they're through with the vetting process. So you'll have the full hours. If it's taken them a while if it takes you a while to call in, if it takes a while for the vetting process to complete, don't sweat it. It's not costing you any exam time. Anyway, good question. But the answer is, I put all that information on the guideline sheet. That's the page I set up for the exam. And whoever's proctoring it will look at it. So what would we raise this to the power of? If we're looking for 10 years out, then the dividend 10 years out, the stock price 10 years out would be found by taking both of these things to the 10th power. So 1.05 raised to the 10th. I get 326 for the dividend. And I get 3421 for the stock price. Anybody get my figures? Good. Okay. One last thing and we'll be done. And actually what I'm about to show you is on slides 21 and 22, and I'm not going to bother with the slides. Here is your stock valuation model, dividend model, right? So this is in the category of what happens. What happens if investors revise G to a higher value? In fact, let me express the D1. You know, that can also be expressed just as D0. Sorry. D0 times 1 plus the growth rate, right? So if investors look in their crystal ball and they think earnings and dividends are going to grow at a faster rate, what happens to stock values? If they think things are going to grow at a faster rate, if G gets bigger, then the stock price goes up. What happened in the stock market yesterday? What did stock prices do? They soared. They jumped the most they've ever jumped in one day since the Great Depression back in 1933. Why? Because analysts looked into their crystal balls and they felt like the economy was going to get stronger, at least stronger than their original estimates. So stock values jumped through the roof. But what if investors my writing, somebody saved me from my writing. If investors think stocks are riskier, what happens to the value of the stock? Here's that same model. In fact, let me move it down a little bit. I'm going to take a trip down memory lane. Remember the CAPM? CAPM said required return is a function of, among other things, beta. So if investors think that stocks are riskier, beta will go up. That's our measure of risk. That'll cause required returns to go up. And when required returns go up, what happens to the value of the stock? It goes down. Stock prices are positively related to growth, they're inversely related to risk. Over the last few weeks, when the stock market has just been taking such a dive, that's because investors felt like things had gotten so much riskier. And that's what drove stock prices through the floor. I don't want to get ahead of the other class, and this is where I finished with the other class. So this would be a good stopping point. Any questions? Where's your confidence level? Paul, I had a guy in the earlier class who'd show me the 10. I like that. I get a thumbs up here and there. I get a virtual thumbs up. I get, Jason, you're hitting that hand that says stop. I'm not sure what that means.
No, that's clapping.
Oh,
That was applaud.
clapping? Okay, I didn't know. So you're feeling, Bryce, you're feeling good about it, Daniel? I hope. All right, Yelin, you too, good. Do you have any questions before we adjourn? Now, you know this meeting is being recorded, and I will post it to YouTube probably by tomorrow afternoon. If you look at the Moodle website, you'll see a link for this chapter under Moodle Zoom recordings. You can click on it, plays a class. So if you weren't fast enough copying notes today, you can always look at that. When do we meet again?
Monday.
Monday at noon. High noon. All right. Guys, have a good week and be safe. Any other questions? All right. This meeting is officially adjourned. Have a good week and be safe. Bye-bye.